Hello everyone and welcome to your Glassnode week on chain video for week 40. I'm your host Checkmate and we're recording this on the 5th of October 2021. Now this week we've essentially seen Bitcoin rally out of the recent consolidation range. So we spent a bit of time down there around 39,000, 40,000, and the market's really rallied up from about 41,000 at the lows, peaking up about 49, and we're actually continuing to rally as we're recording this. So what we're seeing is this strength coming back into the market, and what this generally shows is that the market returns to some kind of profitability. People who accumulated their coins down at cheaper prices, or people who have held onto their coins through this longer term correction over the last number of months, are essentially coming back into profit. And that generally signals a change in sentiment. It generally signals more positive overview from the market at large. And what we're looking at here in this particular newsletter is what is that doing to people's spending behavior? Are we seeing these cyclical patterns playing out? How does investor sentiment play out over different cycles? Looking at the different cohorts of different age brackets and sizes. And then what we also close in on is the recovery in the mining industry. So there's a lot going on in this newsletter, but certainly looking at that recovery of the market coming out of what's been a tough couple of months and really looking forward to seeing where the market could go from here. So let's jump into Glassnode Studio and get started. So as we noted in the intro, we've continued to see some positive price action. And really what we're doing is we're coming off this low that was established around that $40,000 level. And just remember that this occurred after our previous large consolidation between this $40,000 and $29,000 floor. Now we've actually covered this in previous videos, a very similar concept of the total supply and profits. This is the coin value and the percent supply, so of the circulating supply, how many of those coins last moved at a price that is cheaper than the current price. So what we're looking at is how much accumulation. So it's one thing to understand the number of coins. So we're talking about at the moment, some 16.5 million BTC are currently at a realized profit. But what's more important to me, and let me actually zoom in on a 6-monthly basis here, what I tend to look at when the percent supply and profit is I care about changes. So what we know is that people are always spending their coins and moving. Some people are taking profits, losses, and others are stepping in and being the other side of that trade. Now, during this recent consolidation period, what we saw again, very, very similar to what we saw during this correction, is lots of people panicked. Lots of people spent their coins, sold them at a loss, sold them at a small profit, but somebody else stepped in and actually accumulated those coins. So what we've now seen is as price rallies out of that previous trading range, we can actually see the change from about 76.2% all the way up to 87% of the total supply has now returned to profit. So this is something about 10% has now returned to profit. So what we're really seeing there, that change, is telling us a lot about the amount of accumulation that's occurred. So that's really what we're assessing here. We're looking at the amount of coins that have returned to profit, how that changes since the correction that actually pulled us down into this lower trading range, what has happened now that price has moved away from it. And we're seeing about 10% of that coin has been accumulated. So it's telling us that there were people who stepped in, there were coins that changed hands, and ultimately it's telling us something about the demand side that's in the back of this market. Now, what we can then do is actually break that down even further. So this is one of my favorite metrics, actually. This is our long and short-term holder supply, profit, and loss. So it's a bit of a mouthful, but what we're looking at here is in the blue is our change in the amount of supply held by our long-term holders. And then in the red is the change in the short-term holders. Now, what you'll see is if we just look at these in terms of the total blue, so we've got in loss in the light color, in profit in the dark color, and then the same for the short-term holders in red. But note that as we come into the end of a bearish phase, so we're coming into the early stage of a bull market, the long-term holders start to spend their coins and their total supply in blue starts to decline. Those old coins are spent and they move to short-term holders. They're essentially changing hands and new buyers are stepping in. Now, what I also want you to note is that in bear markets, so this is the 2019 into 2020, note how a very large proportion, the gap between the profitable coins is quite large. This means that essentially there's a whole lot of people who accumulated their coins at higher prices and they're currently holding them at a loss. And this occurs for both short and long-term holders. But note that as we squeeze in towards the bullish trend, in particular, note that the short-term holders start to return in many instances to a larger degree of profit than the long-term holders. There's more of these long-term holders who are still at a loss, but they're also strong hands who are going to stick around. They've seen some volatility. They're used to this kind of thing. But as we see more of these short-term holders coming into profit, psychologically, they become more likely to actually want to hang on to their coins. So we see this squeezing in, the gap of loss-making coins gets smaller and smaller and smaller until we reach peak hodl. This is the point when long-term holders hold the maximum amount of coins. Price has started to rally. We know that short-term holders, this is short-term holder accumulation. Because price is on a gradual incline, we're seeing more of these short-term holders coming into profit, and we can actually see it graphically squeezing until bang. We end up with our bull market trend. Short-term holders come into the market. They are largely at profit because the market continues to make all-time highs on a consistent basis. But simultaneously, long-term holders are spending and distributing their coins to those short-term holders. Now, what eventually happens is we essentially get a repeat of the cycle. Eventually, too many coins flow into the system. We get a top that was put in here in April. We then have this widening up again of the loss-making coins. They start heavily short-term holders. But over time, more coins get accumulated, such as this $29,000 level, such as this recent $40,000 level. And what I want you to note at the moment is see how the short-term holders are actually returning to quite a bit of profit. This is giving us, again, that indication that a lot of coins have been accumulated in the last couple of months during both of these corrections. So it's starting to tell us a little bit about the buy side, the demand side. So we have around 15.5% of the supply was accumulated within the last 5 months by these shorter term holders, and they're now increasingly at a profit. Long-term holders own about 73%, and this leaves somewhere around 11% of the coin supply that's currently at a loss. So we can see that this is actually starting to squeeze in a little bit. It's not quite there yet, but it is certainly heading in the right trajectory. So what's important to see now is, are these long-term holders and short-term holders going to start spending and taking profits, and we kind of have a bit more chopping around to do? Or is this actually starting to look a little bit like what we saw back here in 2020, where we're starting to get this squeezing in, more people come into profit, and it starts to actually build that positive sentiment and actually pave the way for more constructive price action? Now, two more metrics that really try to describe this. The first one is our net unrealized profit and loss. Now, what this metric is doing, so that was really looking at the total coin supply, how much of the supply is in profit or loss. What we're looking at here is now quantifying that to say, as a percentage of the market cap, how much is unrealized? What's the unrealized profit when it's in the case where it's greater than zero, or unrealized loss when it's less than zero? We normally see that during capitulation events. Now, what I want you to note is that through 2020, August 2020 to September, so this time last year, we essentially found somewhat of a ceiling here at this NUPL value of about 0.5. So that's saying 50% of the market cap is unrealized profit. So once we had our strong bull market trend, we started to hit this ceiling level of about 0.7. Right, so this is showing that there's quite a lot of profit, and when there's more unrealized profit, the incentive to sell continues to build. We eventually get our oversupply, and people who didn't sell their coins now see their unrealized gains start to fall. Now that creates a form of psychological pain. People have seen that their portfolio has reduced in value, and that can start to trigger fear, can trigger panic. We saw the capitulation event that really occurred through here. Then we saw people return back into a degree of profit as the market rallied. Now note that we found support. It's almost like a retest of that psychological level, that degree of how much profit is back in the system, around 50% of the market cap. We found support, we bounced, we tested it again, and now we've bounced once more. Now this fractal is actually not too dissimilar to what we've seen in 2017 and in 2013, where we see these deep corrections, these some 50 to 30% deep corrections that really test everybody's conviction. They see their portfolio value decline significantly, and psychologically it creates a point of fear. But those that hang on to it can then actually see that there's a value add. They see the market start to recover, it starts to rebuild that sentiment, and we can then start to rally from that point onwards. Now, conversely, let's flip that observation. What would a bearish case look like if we fell back down below 0.5 and started to, again, print one of these fairly scary price patterns where people are seeing their portfolios start to diminish again? That can again start to trigger the opposite reaction where you get more bearish sentiment into the market. So very much what we're looking at here is quantifying how much unrealized profit or losses in the system and trying to then map that to what kind of sentiment is that generating within the market. Now, these two markets, we're moving into the spending behavior. So now that we've seen this kind of overall profitability return to the system, what are we actually seeing in how people are reacting and spending their coins on chain? And we break this up into two different sections. So we've got our realized profit and realized losses. So this is on a dollar value, how much profit or loss is being realized by coin. So on any particular day, let's say price is 49,000, somebody could always spend their coin that they bought at 55 and realize a loss, and someone could spend their coin from 40,000 and realize a profit. So there's going to be a bit of both occurring on each day, and it very much depends where we are in the market cycle as to what's going on. Now, what's important to note here, with our realized profit, we're just shy of about $1 billion on a 7-day moving median basis. On our realized losses, it's a little bit less than that. We're talking about 300 million or thereabouts on a particular day. Now, what that reflects, as we see prices continuing to rally, despite the fact that we have, let's say, $750 million, and let's just say 300 for simplicity, so that's about $1 billion a day in value that's being spent. Now, of course, some of that's not necessarily being sold, but some of it will be. So let's just take the upper bound case and let's just say $1 billion worth of value is being sent to an exchange. And therefore, in order for the price to go higher, you need at least, or likely more than, $1 billion worth of capital flowing in per day. So we can use this metric to understand alongside price. So we've seen price rally at the same time as $1 billion worth of coins are being spent. We can say that roughly $1 billion is probably flowing into this market and continuing to push price higher. So it's giving us an indication of the kind of capital inflows that may be coming in order to support a particular price level. So that's a kind of a quantitative view on things. Now what we can also look at is who is actually spending their coins on chain. Now we've got two metrics here. We've got our spent volume age band. So this looks at all of the spending coins. So we look at all the BTC that was moved and we say what percentage of it, what proportion was 1 to 2 years, 5 years, 1 hour, 1 day. And what we can see, note that this top yellow is 1 hour. The next yellow band is 1 hour to 24 hours. So really when we look at the yellow colors, they are essentially less than a day old. And what I want you to first note is just how significant, almost throughout all of Bitcoin's history, note that the vast majority of transactions that are going through the network are younger than a day. Most of the traffic is the same liquid coins circulating amongst themselves, relaying between exchanges, moving between investor wallets, all sorts of behavior going on chain, but most of these coins are relatively young. Now, what we then care about is what's going on with the older coins, because when you see more older coins being spent, as we saw in the bull market, right, February is really the peak. You see this rising up, this increase in older coins being spent as a percentage of volume. That's showing spending, it's showing illiquid coins coming back into circulation, and therefore the market has to work harder and harder, and more demand has to come in to absorb those coins. What we've seen of late is we saw a little bit of that spending on the rally higher. This makes sense. You're getting a rally off the bottom. Some of those older coins are taking profit. They're hedging risk in case we establish a larger scale lower high and this forms into some kind of a bearish trend. But note that as we've corrected and then bounced again, and actually during the May correction, we had a similar behavior, a reduction, a downtrend in these older coins, a downtrend which is even more pronounced in these older coins. Now, what's quite interesting about the current market environment is that coins that are older than about a month currently represent only 2% of all BTC that's moving. That's actually much less. That's half the amount. 4% is what we saw back here in 2019, 2020 in that pre-bull phase. So when we have fewer and fewer older coins being spent, it really is describing a preference for these old hands to hang on to their coins. Now, we know that there's a whole lot of these younger coins that are circulating. We can then look at how big are the transactions, and it tells us a little bit about the participants who are currently in the market. Now, this metric is our transfer volume, so the number of BTC that are moving, but broken down into how big the transaction is. In the dark green, we've got $10 million plus, $1 million to 10 million, 100,000 to $1 million, so on and so forth. So it's showing the dollar value of coin that's moving. So we know that most of the coins that are moving are fairly young, means that they're not coins from old cold storage that are coming back into circulation. But note how we've seen a very, very large uptake of these big transactions, $10 million plus. And this is on an entity adjusted basis. So what it's doing, it's correcting and removing all the exchanges and internal wallets, and it's really picking up what's going on with the economically meaningful activity. So there's two observations here. The first one is that of these young coins, there's a big amount of value moving around. It's showing that maturity of the asset. We've got more of these $10 million transactions shifting around, which says a lot about the different types of market participants. We're seeing this maturation, and you can actually see this from 2020 onwards. Note how the dark green really expands quite dramatically. We're seeing bigger capital, institutional grade capital moving into the space. And the second observation is total volume. So if you sum all of these areas together, we're currently trading near the highs. A lot of the coin volume has actually returned to the market. There's a lot more coin value flowing around. Even though it may not be a lot of active addresses or a lot of transaction counts, that's still actually quite low. But the coin volume that's moving is actually quite large. So we know that they're young, and we know that the size is pretty big. So this is telling us about these market participants and who's actually transacting within the current market structure. And just to really close out on our profitability and spending behavior, we're going to look at our SOPR metrics. So just as a quick refresher, what SOPR is, it's an oscillator talking about the profitability. In this case, a SOPR is for the whole market, but it's discarding all of these yellow 1 hour transactions. So it's removing all those relay transactions that we can probably safely ignore. So a SOPR is the profitability on any particular day of all the coins that were spent by the whole market. It will trend higher when more profits are realized, lower when fewer profits are realized, reset back to a value of 1 when essentially it's cost basis. No profitable coins are being spent, no heavily at loss coins are being spent. It's kind of a bit of a neutral ground. Shows that people are more willing to hodl at that point in time, and it generally shows conviction. When we're below 1, that's a capitulation event. People are realizing losses en masse, and it's showing that essentially there is pain in the market. People are selling coins at a loss. So the same concept applies to our short-term holders, but this obviously filters just for those shorter-term holders. And our long-term holders is in the other side of that equation. We're looking at those long-term investors. So what I want you to note here is on the adjusted SOPR and the short-term holder SOPR, they're somewhat similar in their signals. What we've seen is a period of capitulation through May to July. Same on both charts. The short-term holder is actually more pronounced, so a lot of short-term holders who bought the top realized very, very heavy losses. We then saw a bounce back above and a couple of bounces across the value of 1. Bounce above, and then we saw these retests. This is positive. This is showing that the market was essentially buying the dip, not spending their profitable coins on the correction, but essentially stepping in to buy that dip. What we've then seen is a pullback in the recent, through September, which was a fairly angry month. We've seen price fall down below, so SOPR traded again below 1. And on the short-term holders, it traded down quite substantially. Now, what this is doing, this is testing the market. This is almost the definition of a retest. It's falling below the aggregate cost basis. People are essentially spending coins at a loss. There's a handful in the market that are essentially panic selling. But what we noted in our previous chart with the percent supply and profit, we've essentially seen that people were stepping in and buying that dip. So there were people who were panicking. There were people who were realizing losses, but there was more demand than sell side. And that's the signal that you can probably take away from this. We've now had a bounce back above, and ideally we want to hold up above 1 now. Now that we've had this shakeout, this retest below 1, we do want to hold above there. What we don't want to see is us to fall below 1 and actually start to realize losses again. That can start to look a little bit more like what we saw back here in May to July. What we want to see is that bounce higher and then price continues to sustain it. And on the long-term holder SOPR, we've actually declined to a very, very low level, less than 2. So what this is showing is that the coins that are moving have a profit multiple of less than 200%. So if a coin was bought at 20,000 and it's being spent at 40,000, that's 200% times the capital. So what we're seeing is this very, very low level of profitability by long-term holders. And a big reason for this is because many, many long-term holders actually bought up here in this topping zone. 5 months ago, we were essentially here in April, and prior to that, so the entirety of Q1 in the bull market is actually now classified as long-term holders. So there's just people who have accumulated and held on to their coins at a much, much higher price. And again, that's really showing that conviction returns to the market. And many of these long-term holders are actually hanging on to coins that they've even bought up here at the top, which is quite impressive. So what we're going to close on is our mining market, which, as we know, has been under an extraordinary transition. We've seen about 50% or just over 50% of the mining market turn offline almost in a handful of weeks through May. And what we're starting to see in our difficulty adjustment is a serious recovery. And this week we've actually had a difficulty adjustment to the upside, and we're seeing that difficulty is continuing to climb. We're back here around January 2021 levels, and really we're actually not too far from a full recovery. It's quite remarkable how quickly the market is recovering in that front. And we can see this in our difficulty ribbon. So what the difficulty ribbon does is it takes many, many moving averages from the 200-day, which is very, very slow, to the 9-day, which can be much faster, and it paints them into this ribbon. Now, when we get a drawdown where the 200-day in red is cut down below, so the 9-day cuts below the 200-day, we get this deep correction. This is basically saying that the difficulty has fallen quite dramatically, and the 200-day is taking longer to correct for that. The 9-day is much more responsive. Now, previously we saw this in 2018. That was the last time we really saw this type of event, and that took 164 days to fully recover. We're about 120 days or 121 days at the time of recording into this correction, and it looks like we're about to get this full-scale recovery. So that's starting to show that the miners are coming back online. The incentives to mine Bitcoin continue to be quite impressive and pulling more of these miners in. And speaking of incentives, we've got our total miner revenue. So this is priced in dollars. How much revenue per day is the Bitcoin network paying to all of its miners? It's obviously distributed amongst all the different miners, but it's saying how much incentive is there to mine. Now, when we think about Bitcoin's security model, it essentially requires that there is enough revenue for people to continue to invest hardware, CapEx, OpEx, and building up the mining infrastructure. Now, you would think that when the halving occurred back here in May, we essentially had a profit of around 17.6 million per day. That then halved to 8.9 million per day. Now, you would think that now that we've gone from 12.5 to 6.25 BTC, that mining revenue and the security is going to be cut by half. But what we've seen is that even with 6.25 BTC per block, plus the fees, we've now seen that revenue has spiked. We've seen a sell-off down to 22 million, but we're currently trading up here around $40 million. So that is multiple percentages. It's almost 600% more than where we were down here at 8.9 million. We're trading up here at 40 million to 48 million. We've got a very significant increase because the price of the coin has risen even though the halving event has taken place. And this is actually a trend that seems to occur over and over, that the mining market continues to be able to fund increased mining infrastructure, more miners coming online. So really the takeaway from me personally is just how incredibly resilient the Bitcoin network really is. I mean, very few industries, let alone an asset or an open source piece of software, very few industries could see 50% of their industrial base essentially switch off overnight and the network continue to work as operated, right? It continues to solve blocks continue to come in. And over time, we're seeing that regeneration. The network, the incentives are pulling people in to essentially turn on rigs, and the market is coming back online, which I personally find quite exciting and a really, really fascinating part of Bitcoin as a network and as an asset. So thanks as always for tuning in. Hopefully you found this useful. Do give us a comment, a review, and a subscribe. And I certainly look forward to seeing you in the next week. Until then, cheers.